Alright, let's dive into the heart of one of the most commonly misunderstood financial concepts that's been floating around forever: money in the bank. It sounds simple enough, right? You deposit your paycheck, see a positive balance, and voila, you've got money. But here's the kicker. What if I told you that, in reality, there's no actual money sitting in your bank with your name on it? Yeah, it's a little mind-blowing, but bear with me. Let's break it down from the very start. When you think about money, you probably picture the familiar banknotes in your wallet, that crisp £20 note, or maybe a few ones and fives depending on where you're from. In the UK, it's all about that £20 bill, right? And in the US, it's the iconic greenback, the $20. But here's the twist. That physical paper, the stuff you think of as money, isn't really money at all. Instead, it's a symbol of debt. I know, this is where it gets weird. Stick with me here. Take a look at a £20 note. What does it say on it? If you squint, you'll see, "I promise to pay the bearer on demand the sum of £20. Now let that sink in. That's not an offer of payment. It's an IOU, a promise to pay. When you hold that £20, what you're really holding is a piece of paper that represents a debt owed by the government to you, or anyone who holds that note at the time. So technically speaking, that banknote is just a record of debt. It's not money in the traditional sense. It's a statement that the government owes you a certain value. The moment you walk into a bank and deposit that cash, what you're doing is lending the bank that money. They hold on to it, and in return, they give you a statement saying, "Hey, we owe you money. Here's your balance." But wait, it gets even crazier. When you look at your bank statement, you see that number on there, your savings, your balance, but none of that is actually physical cash. It's just a number in a ledger somewhere. This is what the financial world refers to as bank debt. And here's where the line between what you think is money and what it actually is gets super blurred. Even though it feels like you've got a nice pile of cash just waiting for you at the bank, there's no vault with your name on it. No safe filled with cash that's tied to you personally. What you've really got is just a record of what the bank owes you. That balance you see isn't backed by gold. It isn't backed by physical assets. It's simply a digit in a ledger. And if you look at the bank side of things, it's the same. They've recorded that debt on their books, and they owe you that money. But again, it's not sitting there in tangible form. Now you might be thinking, so what? Who cares if it's not physical cash? Well, here's the kicker. If you think that having money in the bank means you've got guaranteed access to real, tangible funds, think again. Because what happens if the bank goes bust? What if your bank collapses? In theory, you're still owed that money. But will you ever actually see it? Here's the truth. If a bank fails, your money, at least above a certain threshold, may never actually make it to you. That's why the government backs up your deposits to a certain amount, in the UK up to £85,000. But anything beyond, that is on you. Let's step back for a second and think about this. Everything we use as money today, from those paper bills to digital numbers on your bank statement, is just debt. When you deposit your cash into the bank, you're not putting your money into a vault where it's just waiting for you. No, it's going into a system that records who owes what, and the bank is just a bookkeeper keeping track of these debts. And here's something even more critical. The way modern banks function today has shifted completely from what you might have learned in school about how money works. You see, money used to be backed by something tangible, like gold or silver. That was the basis of what's called the gold standard. Up until 1971, you could technically trade your dollars for gold. But after that, boom, the relationship ended, and banks stopped holding physical commodities to back your deposits. What does that mean for you? It means the money you think you have in your account doesn't even exist in a physical sense. Instead, all you're dealing with is a record of who owes who, and when you make a transfer or payment, the bank is essentially moving that debt around. You're not moving actual cash, you're moving numbers, credits and debits from one account to another. Banks these days don't even need physical branches for this. They're operating on a purely digital level, and what they're really doing is managing and recording debt on a massive scale. But here's where things get really important. This is all fine and dandy as long as the system works and banks stay solvent. But what happens if a bank collapses or experiences a financial crisis? Could you lose everything you thought was safely in the bank? Absolutely. That's the reality of our modern financial system. We live in a world where money is just a record of debt, and if the system falls apart, there's no physical cash you can hold on to. Now, the likelihood of a major bank collapse is relatively low in most developed economies. We haven't seen anything as catastrophic as a bank collapse in the UK since 1960, and even then, it was an isolated incident. However, there have been major scares. Take the Northern Rock debacle back in 2007. That was a serious moment in UK financial history when a bank almost went under. Fortunately, the government bailed it out, so customers weren't left in the lurch. But let's be clear, if the bank had failed and the government hadn't stepped in, people would have found out the hard way that money in the bank isn't actually money. In practice, if you owe money to the bank, they'll simply show that as a negative balance. If you're in credit, they owe you. But the relationship is the same. It's all about debt. There's no stash of money sitting in the back of the bank with your name on it. It's just numbers on a screen, just a record of debt. So, the next time you say you've got money in the bank, I want you to remember this simple fact. No, you don't. What you have is a promise, a statement of debt from the bank that they'll pay you back when you need it. In the eyes of the bank, you're actually a creditor. They owe you that money. And if the system breaks down, or if the bank doesn't have enough assets to back up its debts, then your money might just disappear. It's a hard truth to swallow, but understanding this concept is crucial to understanding how our modern economy works. It's not about cash, it's about debt. Every dollar, every pound, every euro, it's all just a representation of debt that's being moved around, transferred from person to person. In the modern world, there's no such thing as money in the bank. It's just a ledger of debts floating around in a system of promises. So the next time you're looking at your bank balance and thinking you've got a stash of cash sitting there, remember, it's not cash, it's a promise. And the only way it's worth anything is if the system stays intact and people keep believing in it. Once that trust is broken, the whole thing falls apart. And when that happens, you can kiss your money in the bank goodbye. Now that you've got this big picture view, I want you to think critically about how all of this works and why it matters. We live in a world of debt, not cash, and if you truly understand that, you can start to see how the whole economic system is built on fragile trust. And that, my friend, is the key to navigating the future of finance. So, what are you going to do with this knowledge? Let me know in the comments, because this topic is far from over, and it's time we start asking the real questions about where our money really comes from and where it's going.